Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services Leader. You can follow me on Twitter at xbordertax. This week, we're in our DC podcast studio, where I'm joined by former co-leader of PwC's International Tax Services practice and current Washington National Tax Services partner, Tim Anson. Tim, welcome to the podcast.
Thanks, Doug. Good to be here, and good to be part of the audience here for this broadcast, so thank you.
Well, Tim, I have been doing this for 20 years in September, international tax lawyer, accountant, and these new Section 245 Cap A regulations have seemed to create a stir like no other regulations that I've seen throughout my career. And we've seen a bunch of controversial regulations. We've already seen some interesting comment letters with respect to 245 Cap A, interesting and entertaining for that matter. But maybe before we dive in, can you just remind everybody, what is Section 245 Cap A? We've spent a lot of time on the Cross-Border Tax Talks podcast talking about our new territorial system, but just before we dive into these temporary regulations that have really created a lot of stir and controversy amongst us international tax nerds, what is 245 Cap A? And then we'll dive into the temp regs.
Sure, Doug. And remember, 245 Cap A is all about implementing the territorial system that we have, right? Which is really the repeal of deferral, taxation of all earnings, either under Subpart F, GILTI, and then what's left is earnings offshore that can be repatriated to the U.S. with 100% DRD. So these regulations are all about implementing those rules under our territorial system, but scaling back when the DRD may be eligible. So certain transactions that generated E&P, if considered abusive by the government, will no longer be eligible for the DRD. And so these regs are all about what transactions fall into this category of kind of abusive, so that the related earnings will no longer get the DRD. And of course, the regs came out in June, and people undertook transactions before June, obviously. And so the rug is a little bit being pulled out from some of these taxpayers on transactions they did, relying on pretty clear reading of the statute to kind of change the result. So that's why you're seeing a whole lot of controversy, a lot of commentaries about these regs, and a lot of talk about whether they're valid or not.
Yeah, so this dividend received deduction under 245 Cap A generally applies to earnings that have not already been subject to U.S. tax. And so under our new system, we obviously have Subpart F, but then we have the new GILTI regime. So we've spent a lot of time talking about this. The prior podcast, we talked about the final GILTI regulations. And generally, anything that is beyond or a 10% return on depreciable tangible asset as CFC is generally going to be subject to our GILTI rules. And those earnings that are otherwise not subject to GILTI, those are the earnings that can be brought back to the U.S. Now, some of that may be from a 10% return on the QBI. It also, we may have some untaxed earnings and profits as a result of tested losses that otherwise reduce your GILTI inclusion. But most U.S. multinationals and foreign-based multinationals with foreign subsidiaries underneath the U.S. will have a GILTI inclusion, but then they'll also end up with some earnings and profits that is not subject to immediate U.S. tax. And those are the earnings that can then come back tax-free to the U.S., subject now to these temporary rules. And what we saw a lot of, and I think a big issue with this, was the difference in effective dates for the Section 965 toll charge inclusion, as well as then the effective date for when GILTI could apply. And so these issues were really for fiscal year CFCs that had a difference between when the amount of the all E&P inclusion, the historic E&P inclusion under Section 965, and then when the GILTI rules actually started. And so there was what I think has been referred to in commentary, a gap period, a donut hole, I've heard people refer to it as, that effectively resulted in this time period between when the 965 inclusion was measured and then when GILTI started. There was a time period where some taxpayers could have taken advantage of doing a step-up transaction, for example, the Treasury obviously viewed as abusive that they were trying to go after. But before we even dive into some of those, this fundamentally to me seems like an issue with respect to effective dates. And this was also something that was mentioned in the Joint Committee of Taxation's proposals, if you will, or as part of the Blue Book of potential fixes that may need to be done from a statutory perspective. And we'll talk about the difference between the extraordinary disposition accounts and the extraordinary reduction accounts. But it really appears that Treasury tried to fix some of these issues that were identified by the Joint Committee as statutory problems through the regulations.
Yeah, I would say that Treasury was handed a difficult hand by Congress. I mean, when you look at the effective dates, as you mentioned, if you have a fiscal year CFC, then fiscal years ending in 18, let's say 11/30/18, that year was not covered by GILTI. GILTI doesn't kick in until the following year. And so earnings generated during that fiscal year escape GILTI. And if the transaction happened after December 31st of 17, the earnings escaped 965, the toll charge. And so there is clearly a gap period based on the effective dates chosen by Congress. And so Treasury is trying to take that and say, geez, that gap period allows taxpayers maybe the opportunity to step up the basis in IP and other assets, create a whole bunch of E&P, and then bring that E&P back to the U.S. with a DRD, but then take the step up, the amortization on that step up in IP, for example, against tested income in the future. And so that is what Treasury is trying to shut down, but they have a Herculean task, I think, given the effective date. But, I got to give them credit. I mean, Treasury has been very clever and creative in kind of making the argument in the preamble of the regs to justify what they've done. And the whole argument is that, well, geez, without 245 Cap A working properly, then the GILTI regime is undermined because it would, allow for step-ups and reducing future tested income. So we have to have 245 Cap A applying during the gap period so that these step-ups that reduce future GILTI can't happen. And I think, the real challenge for Treasury is, an effective date chosen by Congress, right? Some people win, some people lose on effective dates. And for Treasury to go in and kind of surgically decide certain provisions are not going to be covered by the effective date and kind of override that in a regulation, but then leave the effective date for all other provisions where taxpayers could win or lose, just seems like a real stretch on their authority to be able to do that. So that's where we're going to, I think, see some taxpayer challenges, to the regs, validity and so forth, and we'll see what happens.
Yeah, and I think the challenge that a number of taxpayers face, given the retroactive nature of these temporary regulations, in other words, the temporary regulations just came out, but they're effective for tax years beginning after January 1st, 2017, so back to the inception of the TCJA.
Right.
There were a lot of taxpayers who maybe had engaged in these types of step-up transactions. And to be clear, these type of step-up transactions were mentioned in commentary and panels. There was, I know, a piece written by Harvard professor Stephen Shea, who used to be at Treasury, who very much outlined these types of step-up transactions that resulted in these extraordinary disposition accounts. And so taxpayers had engaged in those types of transactions, and then if they paid dividends either between CFCs or back to the U.S., or otherwise maybe sold the CFC and had a 1248 and E&P inclusion, companies and taxpayers may have issues for transactions that they thought were kind of between these periods, and that's a real issue.
Oh, definitely. And so there's a lot of, not a lot, but a fair number of companies who did undertake the transactions you're talking about, did the step up, paid a dividend, and either are claiming 954C6 look-through on the dividend, or they paid it back to the U.S. and they are claiming 245 Cap A and may have taken financial statement benefit for these transactions, and now the regs are out and they're temporary, they're law, And so the question is, these companies are going to have to reevaluate their financial statement position and determine whether or not to reserve on this item, not to mention tax return filings and what position do you have, to file a tax return with the 245 Cap A, DRD, or 954C6. And the issues aren't all the same technically. I mean,
right.
there's a different technical analysis depending on what issue you have. If you paid a 954C6 dividend, I think you've got really good arguments to say, well, geez, how can they deny 954C6, which wasn't really even modified by TCJA? It was for hybrid dividends, but these are not hybrid dividends. And so outside of a hybrid dividend, 954C6 wasn't amended at all. So how does Treasury have the authority to amend that, back to the date of TCJA when it really wasn't changed by TCJA? And then you've got 245 Cap A, which is similar but slightly different set of issues. And then the whole step up and whether or not you get it for tested income going forward, that's a different analysis. So lots of issues, some better or maybe worse than others in terms of defending the position. But in my 37-year career, I don't think I've seen more validity questions in ever. They're just
right.
They're just coming up everywhere.
All right. So there was nothing in between when you started 37 years ago when I started 20 that
not
we've
a whole
seen.
lot.
All right. So let's unpack some of that because I also want to talk about the extraordinary reduction account, which is something, as you know, I feel a particular interest in. I wrote an article about 10 or 15 years ago on 951A2B that, frankly, nobody read at all until the TCJA, and then all of a sudden I started getting questions about this article.
You're ahead of your time, Doug.
Apparently,
yes.
On the extraordinary reduction. But let's start with the extraordinary disposition account. Can you remind us what is an extraordinary disposition account? We already talked a little bit about it. How does that come into place? And then what's interesting with the extraordinary disposition account, they only say 50% of the 245 Cap A dividend is disallowed to kind of put you back into the same roughly taxable income position that you would be with GILTI. But tell us a little bit about the extraordinary disposition.
Yeah. So an extraordinary disposition is a disposition of an asset, let's say IP, for the purpose generally of getting a step up. It's to a related person during the gap period, when GILTI doesn't apply. And it's got to be out of the ordinary course of trade or business. So you're kind of doing it for step up reasons, not as part of your normal business. And IP, step ups on IP are per se not ordinary course. So every IP disposition is basically caught by this rule. And if you have one of these transactions during the gap period, then the earnings that are generated from the transaction, if paid, after December 31st of 17, taxpayers would have thought they get a DRD, but these regs say, no, you don't get a DRD out of those earnings. And so they're not going to let you get a step up against future tested income and also get a DRD of the related earnings back to the U.S.
Yeah, so let's imagine a taxpayer who has a tax year end, let's say June 30th. Mm-hmm. So a fiscal year CFC, and we'll put to the side, taxpayers that have different CFC tax years than the parent company. Let's just assume it's a June 30 year end. Mm-hmm. So the idea was somewhere, let's say in 2018, between January 1st and June 30th of 2018, that is after the toll charge was determined, but right. before those CFCs would be subject to GILTI, because those CFCs would not be subject to GILTI until July 1st, 2018 and thereafter. So somewhere between January 1st, 2018 and June 30th, 2018, maybe one CFC sold its IP, whether it's actually sold it or through a disregarded entity, to another CFC to get a step up.
Right.
And the idea is that E&P was not yet subject to GILTI, but the basis that the acquirer in that IP has could then reduce its GILTI going forward through amortization, depreciation, whatever the case might be.
Right, exactly.
And obviously Treasury was concerned that when you created the step up during this gap period, you now have this amortization. And then the issue is, well, there's also this big monster bucket of E&P for taxpayers that engaged in that transaction. And the point is that 245 Cap A, when that E&P is distributed, if you had this extraordinary disposition, you only get half of the 245 Cap A deduction. Effectively, half of it would be subject to tax, so that it is subject to tax at 10.5 or what otherwise would have been if it was GILTI.
Right.
And so what's interesting about this, I think a number of things that are interesting about this is that, first of all, this isn't a taint of the earnings and profits, right? I think when I originally quickly read the regs before really diving in, it's really a CFC level attribute. In other words, it doesn't necessarily tag to the earnings and profits, but it tags to the entity itself. And then there are also successor rules so that if that entity does some type of reorg or something, that it kind of carries with it. It just doesn't go away, for example, on a 332 or tax-free liquidation. I think where a number of taxpayers have potential issues is maybe where they did that transaction and then they otherwise maybe sold the entity and had it all E&P inclusion that they thought was subject to 245 Cap A, or they made a dividend distribution back to the U.S. that they thought that those earnings were subject to 245 Cap A, or even on the CFC to CFC, if the CFC that did the step up then paid a dividend to another CFC, then that 954, that dividend that we otherwise thought was subject to 954 C6 is not subject to 954 C6 and is now subpart F income. Right.
Yeah. The bulk of what I've seen are companies who did the transaction and then paid a dividend and are seeking either 954 C6 look through or 245 Cap A. But yeah, you're right. If you came inbound in a all E&P inclusion transaction, again, that's a deemed dividend, and you would have thought that you get a 245 Cap A DRD for that. But so there, fair number. I mean, there's a fair number who did the step up transaction but haven't paid any dividends, and so now they're in a better place than obviously those that did pay dividends. The other interesting thing is just to think about. There's still a technical correction out there,
right? That
would say, the earnings after December 31st of 17, through the step-up transaction, are taxed under 965 toll charge, and so, one would hope that whatever happens to that technical correction, that there be some coordination between what they've done in temp regs and future technical correction to make sure that you don't get kind of even a worse result than you do under the temp regs, and to be determined on what if anything happens on that technical correction proposal.
Well, along those lines, talk about the concept of, first of all, the fact that those earnings and profits are not subject to 245 Cap A, and you can end up with subpart F or taxable distribution in the U.S., but also whether that step up now can actually reduce guilty, because that sort of seems like it's doubling up potentially as well. I say doubling up. In other words, either the E&P is subject to U.S. tax, you would think, or you otherwise wouldn't get the deduction for guilty purposes. Taxing both seems to kind of be doubling up.
It's kind of heads they win, tails you lose kind of thing going on. But yeah, so you don't get the DRD or look through, and now the rules they came up with for what to do with the amortization of the step-up piece, they don't say that you can't, that's not deductible. They say, okay, you can amortize and get a deduction. It's just that the deduction is not allocable against tested income. So it basically is useless to you. I mean, you have an amortizable asset that doesn't reduce tested income, doesn't reduce subpart F income either, and it's kind of a wasted amortization. So that was a little tricky too. And I think they probably felt it was a little bit daunting given that the statute says to apply the 954B5 rules for allocating deductions, which then punch you to the old 861-8 rules that have been around since the beginning of time. And those rules all say that you can allocate deductions to the income to which the deduction factually, I repeat, relates to. And so how do you say that the amortization of the IP doesn't relate to the tested income that it generates? And so it's a little bit of a stretch to kind of override 60 or so years of regulations, and even the current references to 954B5 and 861-8 would seem to suggest that factual relationships should dictate the result, but that's not the way they went.
Yeah, so you get the deduction for E&P purposes, I think they acknowledge, but then what is really under the new system, E&P, it really just that E&P that's not already subject to U.S. tax, that's what's subject to 245 Cap A. So it seems they almost got at this at coming at two different directions, but exactly I like the way you put it as, heads they win, tail you lose.
Yeah, and E&P is kind of a less meaningful concept these days, right? Because, first of all, guilty isn't limited by E&P.
Right.
And most earnings are going to be taxed under guilty. So, getting a deduction for E&P isn't exactly, I think, what taxpayers need or want.
Right. All right, so let's move to the extraordinary reduction account. And this really is mostly in reference to a statutory provision, Section 951A2B, which, again, is near and dear to my heart from this article that I wrote like 15 years ago that nobody had read until recently. And generally what 951A2B tells us, and this was part of the old architecture, the pre-reform, that generally said if a U.S. shareholder transfers stock of a CFC to another U.S. shareholder, so let's say U.S. shareholder 1 sold CFC stock to U.S. shareholder 2, the idea was that if CFC 1 or CFC had made a dividend distribution to U.S. 1 in the same year that it was sold, and that U.S. ended up with the Subpart F inclusion, the Subpart F inclusion is determined at the end of the year, so the acquiring entity would generally have the Subpart F inclusion, but US 1, who sold the stock, who received a dividend, that PTI from the Subpart F wasn't generated until the end of the year. So absent Section 951A2B under the old system, US 1 could have a taxable dividend that wasn't PTI because it wasn't the US shareholder that had picked up the Subpart F income. And then when US 2 acquired the stock of the CFC, it would have a Subpart F inclusion, so you would effectively tax the same income twice. Right. And so 951A2B made a lot of sense under the old system because it would otherwise reduce a double inclusion. Well, now, of course, with our new tax system, where now we have the Section 245 Cap A dividends received deduction, 951A2B, interestingly, was not touched or changed as a part of TCJA. My personal opinion was that maybe was an oversight as part of TCJA. I think the JCT report kind of references that, but doesn't go quite that far. But functionally, what happens with 951A2B now is that in that fact pattern, absent these new temporary regs, the U.S. shareholder that sold the stock of the CFC would be able to get a dividends received deduction under 245 Cap A for those earnings. And then the U.S. shareholder that would receive that guilty inclusion may have less, potentially have a guilty inclusion or less of a Subpart F inclusion when they would, at the end of the year, when they would measure those earnings. So tell us a little bit about what is the extraordinary reduction account. And what's very interesting to me on this one is that instead of denying 50% of the deduction to kind of put you back in the same spot where you are with guilty, the extraordinary reduction excludes the entire dividends received deduction.
Yeah. So, and I think they were going after out from under transactions, at least as one category where you had foreign parent, U.S. group, CFCs, and some companies would sell assets up to the foreign parent, create a bunch of earnings underneath the U.S. at the CFC level, and pay a dividend back to the U.S. and get a DRD, and that dividend would well, in that case you wouldn't even have a guilty inclusion because the ownership is up
Right.
at the foreign parent by the year end. But also transactions like you mentioned, one U.S. shareholder sells the CFC to another, and could be a 1248 transaction, and that creates a deemed dividend, which would have otherwise been eligible for the 245 Cap A absent the new regs. And then the recipient says, well, geez, my pro rata share of guilty at the end of the year is X, but I get to reduce it for the dividend that the other shareholder got. And so my inclusion may be lower or maybe zero, and you got a DRD to the seller. So and what they say is if you have an extraordinary reduction transaction, they say that the DRD, the 245 Cap A DRD is turned off. So if you had a 1248 transaction, deemed dividend, or an actual dividend to the seller, no DRD on that transaction, and no FTCs, no offset, for other tested losses that you might otherwise get if it were a guilty inclusion, and no offset for Q-buy. So it's pretty punitive. I mean, you're paying the full freight of tax at 21%, no credits, no Q-buy, no loss offset. And so what they've done in the regs, they say, well, okay, instead of nailing you with just a denial of 245 Cap A, we'll let you make a close-of-the-year election. So if the U.S. shareholder who sold the CFC elects to close the CFC's year on the date of sale, then the seller picks up the normal GILTI for the year, and it really calls off the extraordinary reduction rule. So you get your normal GILTI credits. You would get deficits if there was deficits of other CFCs that might offset that tested income, and you'd get the benefit of Q-buy. So you can kind of put yourself in a position almost as if you hadn't sold it for GILTI purposes, and pick up the GILTI freight at 10.5% instead of 21% if you don't make the election.
Yeah, and I'm guessing, practically speaking, that is what a lot of taxpayers are going to have to do, is just elect to close the CFC's tax year, make that election, and just include that for the disposing U.S. shareholder, include that GILTI in inclusion.
Yeah, but the point you raised is the entity or extraordinary reduction transactions, you lose the DRD, whereas if you have a extraordinary transaction, you only lose 50% of the DRD. So it's a much more punitive result to be in an extraordinary reduction transaction.
Right, and again, it follows the entity. It doesn't necessarily follow the earnings, and so. Yeah, as I think about this one, again, I think a lot of the taxpayers will elect it to close their years. I think that any taxpayer that did a disposition transaction, first of all, if your fiscal year, or even if your calendar year, this unlike the extraordinary disposition transaction, this could also apply to calendar year taxpayers. Yeah. Anybody who did a disposition, or frankly, and this doesn't necessarily need to be a third-party disposition. I mean, one of the points of the article that I wrote is, like, if you just transfer as part of an integration transaction, maybe you recently did an acquisition, and you are transferring things amongst your group between two different U.S. shareholders as part of a general integration transaction, 951A2B is not elective. I mean, this rule just applies as is, and as does the extraordinary reduction account. So I think taxpayers that did internal reorganizations as part of an integration or a disposition, whatever the case may be, need to go back and look and make sure that they didn't accidentally fall into 951A2B, because it could have some serious detrimental impact. Yeah,
I mean, the regs with their retroactive effect are going to force people to look at, geez, how did we book some of these transactions we've already done? What about, we're considering selling a CFC, how do these regs impact that transaction, which can affect the price of, targets and so forth. And then not to mention, what positions do companies think they want to take on tax returns, given some of the validity or invalidity arguments that may be out there.
Yeah, and we started off the podcast, Tim, you made a comment about just what a difficult task Treasury had to try to administer these rules. And I couldn't agree with you more. But this is, I think, a great example, particularly this 951A2B, because you absolutely can see the potential for abuse and the fact that this issue was arguably missed by Congress. And, what I struggle with is that code section in the statute is still law, and is very clear with how it is written. And effectively, these temporary regs turn off a statute that would otherwise be applicable. And I know a couple of the questions that I've gotten are, is that within Treasury's authority? Are they able to do that? And I think that also amongst the extraordinary disposition, where there's a number of those issues. And I think if you go back and look at the JCT report, they had suggested really specific changes to 951A2B as part of potential technical corrections to get everything squared away. But I think taxpayers that did any type of change of U.S. shareholders or dispositions need to go back and look to see if they are potentially impacted by these rules.
Yeah, and we all know that this legislation happened kind of at warp speed. I mean, it went through very quickly. And so you can understand how some issues may have been overlooked and just not thought of, dealt with, whatever. But in my mind, that doesn't anymore make a selection of an effective date some sort of a Scrivener's error or some other, minor oversight that allows Treasury to just necessarily, in effect, change the effective date on some of these provisions. Right. I mean, that's a conundrum we have here. It's like an effective date. When you think of it, effective dates can help taxpayers or they can hurt taxpayers. It just depends on your facts. but you kind of live with effective dates. That Congress intended it, and there's a whole range of transactions that may be affected. You can't expect Congress to think through every possible implication of an effective date. And so you'd normally say, okay, Congress picked it. It knows some taxpayers are going to win, some are going to lose. You go with it. For Treasury to, kind of, like I said earlier, surgically come in and be able to change the effective date for some but not all provisions, I haven't seen that in my 37-year career. I just haven't seen them be able to do that and feel good about that reg kind of holding up. So
yeah, so we know a number of the taxpayers, whether they did the extraordinary disposition or have an extraordinary reduction account and brought dividends back or otherwise paid a dividend to a CFC and where they don't get 954C6. Obviously, those taxpayers need to think very carefully about those prior transactions. One of the other traps and issues under these rules are companies that want to do loans back to the U.S. There are a number of taxpayers out there that can't, for example, make dividend distributions of all this 965 PTAP because local distributable reserves, or maybe they don't want to pay the piper on foreign withholding taxes, or any number of reasons that are sometimes difficulties of getting cash out of a non-U.S. jurisdiction to try to bring back to the U.S. What some taxpayers would do a 956 loan to be able to maybe bring some of those earnings back. So talk a little bit about, and so obviously if you've got PTAP to be able to protect the 956, maybe you're okay, but these extraordinary reduction, extraordinary disposition accounts then potentially turn off the ability to be able to turn off 956. But talk a little bit about that.
Yeah, no, exactly. I mean, so, anyone who did one of these extraordinary, transactions and thinks about doing a 956, I mean, a lot of people are only doing this if there's PTI, that they maybe can't distribute because they don't have cash on hand, or they just distribute to PTI. But you then have to take into account these new regs that say, well, geez, if I do a 956, you have an inclusion only to the extent that if those earnings were distributed, you would not have gotten a 245 Cap A. So to the extent you would have gotten a 245 Cap A DRD, a 956 doesn't create any inclusion. And so now we've got another kind of pocket of earnings or issues to think about with these new regs, that if you had an extraordinary transactions with earnings there that couldn't be distributed with a DRD, that will cause a 956 inclusion. In addition to hybrid dividend accounts, which we've already kind of been planning around and taking into account with previous regulations. So another category that makes it hard to bring cash back to the U.S.
Right. And another on the list of diligence items before you make a 956 election, because it's like when I thought we started with the proposed statute of just turning off 956, and they said, okay, well, it's still in the statute, but then they were going to try to change it through regulation, and this is now just another to add to the list of things to be mindful of before you make that loan back to the U.S. I think one of the other things, Tim, lastly, is the ordering rules on distributions when you've got an extraordinary deduction or extraordinary reduction account. Just a little bit about that. I think they at least allow us to get out some of the PTAP and the good earnings first. Right.
So if you've got, these kind of tainted earnings that we've been talking about, but you've got C3 untaxed E&P greater than these, the tainted earnings, the rules say that if you make a distribution, they come out of the untainted, the good C3 E&P, so that you can claim your 245 Cap A DRD. And so, it's important to know what your pockets of E&P are, how much good E&P versus, the tainted. But at least, we'll call that a favorable rule, I guess. They gave us a favorable ordering when distributions are made.
Yeah, one of the common themes throughout the course of the podcast that we've done is just the unbelievable amount of compliance that taxpayers now have.
Oh my, yeah.
And this is just another group. So this is E&P, right? It's not necessarily guilty earnings, right? This is another kind of category, if you will, of E&P that taxpayers are going to need to track. So we have our tested income, and now we have the E&P. We have our 11 different categories of PTAP.
Oh my gosh!
And now we have the extraordinary disposition, extraordinary reduction as kind of components, if you will, of the 959C3. It's a lot to
keep ordering rules of ECI, Subpart F, guilty, and then 245 Cap A. All these ordering rules. There's a ton. I guess one thing I would say, talking about DRDs like we have been, wouldn't be complete without saying something about Section 78 and the 245 Cap A DRD. I mean, that came out in the GILTI regs, so not as part of these regs, the 245 Cap A regs. But the whole issue of, do you get a DRD for a Section 78 gross up for either a first tier, and some firms would say lower tier CFCs, that issue has been out there for a while, but it's another issue in terms of, what did companies do for financial statement purposes? And now that regs have come out fairly recently, what does that do to their book position? What does it do to their tax return filing position? And that one, the way I look at it is the statute is absolutely crystal clear that you get the DRD on a Section 78 gross up on a 965 toll charge inclusion. But the policy seems about as equally crystal clear that you shouldn't get it because they deny it going forward, other than the gap year. This is a 1 year, the gap, year, the same gap year we've been talking about for step ups. And so, the question is, if I have a statute that's in my favor and it's crystal clear and I get it, but I have a policy that's against it, and that's pretty crystal clear, where would the courts come out on hearing that issue? And so that's generated a whole lot of discussion, a whole lot of attention. Some of these numbers are quite large for some of the companies.
Well, Tim, a lot for taxpayers, practitioners, and the government to think about. So I think we'll leave it at that. Thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Tim Anson from our WNTS office, for joining me on this episode. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of Cross-Border Tax Talks.